If I told you that a three-digit number was going to determine whether you pay $50,000 more or less for the same house, would you know what I'm talking about? When we talk about credit scores, that little three-digit number can make thousands of dollars worth of difference. And it's not some abstract financial concept, but again, actual dollars. Tens of thousands of dollars over the course of your life, hinging on decisions that we're making right now in our 20s. So today I want to talk about just that. As a certified financial planner, I want to give you the rundown on what a credit score actually is, what moves the needle, how to start building credit even if you have nothing right now, and how to use a credit card in the right way as a wealth building tool and not a debt trap. Now, I want to clear something up. Your credit score is not a measure of how good you are with money. It's not a measure of your net worth, your savings rate, or your financial health. It's specifically a measure of how you handle debt. And I know that sounds simple, but that distinction really matters as I know a lot of people, and even clients, who are genuinely responsible with money, but still have a mediocre credit score only because they never use the credit system in a meaningful way. Your score, and the one that you'll most commonly hear about is your FICO score, runs from 300 to 850. Anything above roughly 740 is going to get you the best rates on really anything. Below 620, and you're going to start running into real problems. So your score is built from five factors, and these are not weighted equally. The biggest one is your payment history, and that makes up 35% of your score. And it's just whether you pay your bills on time or not. Simple stuff, but incredibly impactful, and again, the biggest part of your credit score. The second biggest factor is credit utilization, which makes up 30% of your score. Again, really large part. Utilization is simply how much of your available credit you're using at any given time. So, for easy math, if your credit card has a $1,000 limit and you're carrying a $300 balance, your utilization is 30%. Most guidance says to keep it under 30%, but if you really want an excellent score, you want to be closer to 10% or below. Three remaining factors are length of credit history at 15%, mix or type of credit at 10%, so consumer debt versus a mortgage or a car loan, and new inquiries at 10%. These three largely take care of themselves over time if you get the first two portions that we talked about right. One more thing before we move on, checking your own credit score does not hurt it, and I think you should check your own credit score. It's called a soft inquiry. But what does hurt your credit score is called a hard inquiry. It's a temporary dip when a lender pulls your credit because you applied for something. The dip is typically minor and fades within a few months, but I just wanted to point that out. Now, how do we start building credit? An issue that a lot of people in their 20s run into is you apply for a credit card and you get denied. And it's not because you have bad credit, it's just the fact that you don't have any credit. Lenders look at your file and there's literally nothing there. They refer to that as what's called a thin file. So, how do we bulk up that thin file into something that lenders are actually impressed by? The most straightforward and I think safe path is what's called a secured credit card. The majority of your large credit card companies offer these, and the way that it works is pretty simple. Put down a cash deposit somewhere around $200 to $500, and that deposit becomes your credit limit. You use the card just like a normal credit card, and you make your payments on time, and the activity gets reported to the credit bureaus just like any other credit card would. After a good amount of time, typically 6 to 12 months of responsible use, most issuers will upgrade you to a regular secure card and you'll get your deposit back. There's also credit builder loans, which most of the time are offered by credit unions and community banks, and these work a little bit differently. The loan amount will sit in a savings account or a high yield savings account while you make payments on it, and at the end of the loan term, you'll get your money back. And this is less about accessing funds and spending and more just about building a payment history on your record. Most credit unions and community banks understand that people are trying to build a credit history and offer these just as a benefit. The last one that I want to touch on is the path that I personally took, which was a student credit card. I took it out almost immediately when I turned 18, and my credit limit was only $1,000. I pulled it out specifically to build credit, and I use it about every other month or so just for gas and just to have a line of credit open to build up my credit history. And fun fact, I still have that card. I'm 25 and I still have it on hand and I rarely use it, but if I wanted to, I could. On that note, even if you're done using your credit card like I am with mine, do not cancel it. If you close this account down, all the history that you've built up over years completely disappears off your record and you don't get the benefit from having that on your credit history. So now that we have a foundation, how do we transform our credit cards and our credit scores into wealth building tools? Credit cards have a reputation problem, which are 100% warranted. I mean, Consumer credit card debt in this country, it's just at record levels, and for a lot of people, a credit card is genuinely how things began to spiral financially. So the instinct to completely avoid them makes total sense on the surface. And if you personally know that for you, a credit card would be quote unquote a gateway drug into poor financial decisions, then ignore everything that I'm talking about and just don't take one out. That's totally fine. And as I mentioned earlier, there are many other ways to build credit that do not include an outright credit card. But here's how I actually think about it: a credit card is only dangerous if you use it to spend money that you don't have on hand. It's a behavior problem, not a product or lender problem. The card itself is completely neutral, and when you use it correctly, it's generally one of the better financial tools available to you out there on the market. The rule's pretty simple: only charge what you would have paid for in cash, anyways, and pay the full balance every opportunity available. If you do those two things consistently, here's what you get in return. The benefits are pretty awesome. You build your credit history, you earn rewards, you get purchase protections that your debit card typically doesn't offer. Fraud liability is significantly more favorable with credit cards than debit cards. And some cards even include rental car coverage or extended warranties built in. So, again, not bad. There's some pretty good benefits out there. But let me say this as a financial planner: if you go this route, I recommend you pay it off weekly or bi weekly and not even wait for the statement. Never carry a balance, because carrying a balance is a one-way trip to financial stress and burden that you do not have to take on if you use your credit card appropriately. Furthermore, on carrying a balance, even if it's a small one, the interest rate on most all credit cards is going to wipe out every single reward that you earned and then some. The average credit rate APR right now is somewhere north of 20%, and it's not a tool at that point. It's a complete and total trap. The math only works in your favor if you pay in full every single time without exception. This system that I'd suggest is pretty straightforward. Set up autopay for the full statement balance. Turn on a spending alert so you always know where you stand, and mentally treat the card like a debit card. If the money is not already in your checking account, then the purchase on your credit card does not happen. The last thing I want to touch on here is why starting now in our 20s matters so much more than starting later. Let's talk about a mortgage, since that's typically the first large financial transaction that most people ever make. On a $300,000 home loan, the difference between getting a rate available to someone with excellent credit versus someone with average credit can easily be a percentage point or more. Run that out over 30 years, and you're looking at a gap of $40,000, $50,000, or even more in total interest paid. That's money that could have gone towards retirement, towards experiences, towards whatever actually matters to you. And beyond the mortgage, your credit score touches more than people realize. Car loans, personal loans, sometimes even apartment applications, and job background checks in certain industries. A strong credit profile can open doors and lower costs across your entire financial life. There's also the factor of time. Credit history length makes up 15% of your score, and the clock starts when you open your first account. Every year that passes is a year of history being added to your file, and if you open your first card at 22, at the time that you're applying for a larger loan at 32, you've got a decade of history behind you. If you wait until 28 to start, you're showing up at that same moment with only 4 years of history behind you. If you found this helpful, feel free to subscribe so you don't miss what's coming each and every Tuesday. I'd love to have you along for the ride here with me. Also want to shout out our Discord server where you can receive free personal pro bono financial advice from myself as a certified financial planner. The link is in the description, and I'd love to chat with you there. As always, it's been Q All, and until next time, enjoy the fog.